Ladies and gentlemen, it's a great pleasure to be here, but I had a nervous moment there. I saw a competitor on the stage with a crystal ball. It is indeed a great pleasure to be here. I was here yesterday and I heard some great speakers. And I want to say something briefly about those speakers. It started with a very, I think, moving speech by Hall Gregerson, which described his journey from a photographer to a business leader, inspirational speaker, and an innovator. And later on in the afternoon, we had, of course, Jeremy Billison there. And he showed us a little bit of a glimpse about the future and virtual reality. And someone asked him a very good question towards the end about good and evil. And Jeremy tried to define that by saying, well, I think in virtual reality, you should only do what you would also do in real life. After he had just shown us that video of the superhero going through the city. So I thought that was a little bit funny. So we've had a photographer and a superhero, but I was warming up for the evening. And this is why I'm telling you this. Because I was a bit disappointed in Rabobank yesterday evening. Now let me explain that. I was told the president was coming, but the president wasn't there. He was lighting the tree in the White House. Instead, they sent a painter from Dallas. But he acquitted himself well. And if he ever wants to run for public office, and Mr. Trump allows me a passport, I will vote for him. Enough nonsense, let's get started. I'm talking with you today about currency wars. You see, when people come up with a financial markets outlook, the risk is that I bombard you in sort of 30 minutes with regions, growth figures, unemployment, inflation, currencies, all of them, rates, all of them, and you leave thinking, well, bedazzled probably, hopefully, but you leave with a lot of information, but precious little insight. So instead, I've picked one theme that I think captures most of what's going on in the financial markets at the moment. And I hope that will leave you with more insight than just tables of forecasts, which are still on the website and you can still look them up. We still do produce them. So it's currency wars that we'll talk about. And we'll do it sort of like this. I want to take you a little bit to the past, give you a bit of context, because I think that's relevant for the current day. And I think it's also particularly relevant for what it means in the upcoming years, whether we should expect more currency wars. And I want to also see that in the light of the Fed and the ECB. The ECB, which made its decisions yesterday, and the Fed, which will make its decision, of course, later on in the month. So that's how we'll play this. But before we do this, because it's a bit presumptuous for me to pick the major theme, let's ask you if there is actually a currency war. Do you see it? Or is it just that monetary policy is different in different parts of the world and that's why currencies diverge? 4 options. First one is there was a currency war, but it's all over already. The second, we're indeed locked in a currency war, it's still relevant. C is just a sideshow, and D, you haven't seen anything and you wonder why I'm going to talk about it for half an hour. Let's start the clock, 10 seconds. Let's have a look at the results. Okay, good. I did this recently in the Netherlands. 65% believe they were locked in a currency war. I do have a feeling, I think I can explain that 10 percentage point difference, but we'll get to that later. But this is at least enough to back up, as we continue, that we have a relevant case here. Now, I brought actually a slide of my own, just in case if you were saying this wasn't relevant, to try and show that it is. So if we can move to that next slide. I give up control when we do these things. There we go. Bloomberg has this nifty function that if you're not quite sure whether something is being spoken about in the market or something is a market theme, you can search for something. So we input currency wars as a search term. And then Bloomberg comes back and says, this is the count. This is how many articles, how many related stories we've run or others have run in which currency war is a theme. So you can clearly see that it has been periodically a theme and that in recent months it has been a theme because of the spike there in attention. So it isn't just you that believes that currency wars are out there. The market believes it as well, and that makes it particularly relevant. Let's take a little bit of a side tour in history, because I think it's relevant. And I'm starting in the 1930s because this was an era that saw massive currency fluctuations, a big currency war playing out. The world was a different place though. We were on the gold standard. And the British decided, under tremendous pressure, global trade had been collapsing, to drop the gold standard, to go off gold. And that was relevant because the rest of the world was still on the gold standard. So I've shown you here the exchange rate between sterling and franc, the French franc. The UK goes off gold, and the French do not follow. This is not because the French were asleep. They knew what the British were doing, but they believed philosophically that the British were on the wrong track. They thought the British were making a policy mistake. And this is what happened to the exchange rate. As Britain goes off gold, starts printing sterling without backing it with gold, interest rates fall in the UK, and the sterling franc exchange rate absolutely plunges, more than halves. So if you thought you've seen big currency moves, this is a big one. After a couple of years, the French have such tremendous economic damage to their economy done because of this, that they ultimately go off the gold standard as well, and that exchange rate reverses dramatically and quadruples. So very big moves. Now I'm talking about economic impact. Let's have a look at that. This is exports. And you see how much they fall in there when the UK goes off gold and France initially doesn't follow, and how much they recover later on. So this is real figures for you. Similar picture you can show in inflation, where disinflation in France is massive when it doesn't follow, and then ultimately it recovers. Well, that's a little bit of a show far away from home. Let's look a little bit closer, the US versus the UK. There too, Britain initially succeeds in bringing cable, the exchange rate of sterling versus the dollar, down. But the Americans were a lot more distrustful of the British. They were not so dogmatic in economic theory or monetary theory, so they were willing to let the gold standard go a lot quicker. And as a result, they limit the damage quite a bit. You could show similar charts on the economy in terms of exports and inflation, but the damage was less because they reacted quicker. So a couple of I think, relevant lessons here already. First off, currency wars can see very big currency fluctuations. If you thought you've seen something already in the past couple of years, you may have seen nothing yet. The 1930s certainly suggests that currencies can move a lot. Secondly, if you're not playing the currency wars or you're playing it poorly, you will pay a hefty economic toll in terms of exports, inflation, etc. And thirdly, if you don't want to play because you have the moral high ground on all this, you may find that ultimately you're forced to play. We'll get back to that later when we discuss China. So that's nice, the 1930s. But why is this relevant? Why might history be repeating itself at present? And the question, ladies and gentlemen, the answer to that lies in money, the role of money. How does money work? So if you allow me, I'll have a brief tour through history to then draw conclusions for the here and now and the near future. The key issue is, how does an economy get new money? That may be pretty simple at the moment, but it has been quite different throughout history. So we'll start with sort of the basics there. The Greek drachma. We were all afraid it would return somewhere this year. Luckily it hasn't. But in 1100 before Christ, the drachma was a fact. And the Romans decided that they needed more currency. So they invaded Greece, defeated Greece, and took all their currency. That's lesson number one, ladies and gentlemen. If you have no money, you just bash someone to get it. Rome by itself had its own issues. Rome had no real trading competitors. It tended to conquer whoever was on its borders. But it did have something called no taxes for its own citizens. And as the Roman Empire matured, the names of all the emperors have disappeared here, but this is the time over a 300-year time period. They had the problem that they had a tax shortfall. So they started to debase the currency. They started to reduce the silver content in the denarius. So on the y-axis, that's the silver content, and it goes steadily from around 100 to below 10%. And that was purely to make up the tax shortfall. But it gives us our second lesson, which is, if you have no money, you can always devalue what you do have. We make a very big leap, because we do want to get to the present time within the scope of this presentation. And we end up with mercantilism. Now, I suspect that when I say mercantilism, you're leaning back a bit and you're thinking, yeah, that's not good. That's not very good. That's a bit backwards economic thinking, at best economic voodoo. We all know that free trade's the way to go here, so that's not really good. But the principles of mercantilism are not that crazy, actually, especially not seen in historic context. Philipp Wilhelm von Hornig writes about Austria in the 17th century and explains why it is good for Austria to be mercantilist. And mercantilist, and I don't expect you to read all this text, but basically it's 9 ways of saying economic nationalism. Be careful. Keep your added value in your own country. Don't trade if you don't have to. And if you do trade, make sure you are on the right end of it and you receive the hard currency. This makes sense in this world because in this world, money is silver. And silver doesn't come from the printing press, it comes out of a mine, so it's exogenous and it's limited. You have to find another silver mine to get more silver. So if you frivolously start trading with everyone, your silver will flow to that country, they build up a bigger military, invade you, and you're back to lesson number 1, where they bash you and take your money. So that was what mercantilism was all about, mercantilism. And if you think about it, it has made a return, neo-mercantilism, in Asia after the Asian financial crisis, because the Asian countries found out that sure, all that free trade talk is nice, but when you have a crisis, you better have currency reserves and you better have trade surpluses, because else you pay a hefty economic price. So when I gave this presentation in China 2 months ago, everyone thought mercantilism was an absolutely great idea, and I saw a lot of people nodding. Shows you the difference in how people approach this. We'll be back to China later on. So that's the third lesson there. If you don't have enough money, you run a trade surplus, and the money will come to you. Right. Mercantilism ultimately became free trade, and it's very insightful how this happened. You might think that the 20th century was the century of free trade, but actually in the 19th century we had quite an episode of it. And it ran something like this. The British, great thinkers to the last of them, ran a fairly protectionist situation. They were mercantilist. Until the Industrial Revolution arrives. They start producing massive amounts of goods. So they enjoy some of that themselves, but they end up with a surplus that they need to export. So lo and behold, great British thinkers come up with free trade. They come up with free trade so the rest of the world will buy their products. These are tariff barriers throughout the 19th century and the early 20th century. Now you can see when they're at 100%, that means you have no trade. Right, there's 100% trade barriers, tariff barriers. So the British convince everyone, sort of 1815, 1875, to let go of that and to trade with the British Empire. And most countries buy this. There's one country that doesn't, and that's the United States. Probably because of some experiences with the British in the past, they were a little bit more reluctant to trust them. And that actually did them well at the time. But most other countries did buy it, and they paid a price for it because they found out along the course that actually it wasn't so much free trade that made you well off, it was building an empire that did. And hence the trade barriers came back, and all of the others started to get in on that as well, late usually, and tried to build their own empires as well. So if you think of it, it's of course terribly cynical that what we know as free trade was actually not free at all, because all these countries were building empires, and if you went to that empire, it was very, very challenging. How does an empire work? Well, an empire is great on both sides. First of all, you take all their commodities cheaply, so you have all the inputs, and then when you have ready-made products, and you're done consuming them yourself, you force them to actually buy them from you. So you have both supply and demand internalized. It's great. Did lead to a lot of tensions, and arguably contributed to World War I. So there's a lesson. Free trade gives way to mercantilism again, and then empires. Right, we're getting to slowly towards the 1930s, which is our most relevant part. But after World War I, one thing to at least mention is that debt came into view. Germany had a massive war debt that had to be paid. The way it was done was quite crafty. It will remind you of the modern day a little bit. The US was actually lending Germany the money for Germany then to pay back. nice and circular, extend and pretend. It's a little bit what's happening in Europe at the moment. But ultimately, it does go wrong. It contributes to the Great Depression. 1929, it all goes pop, and there we are. So it teaches us a very quick lesson, and that is that if you have debt, sure, that helps, but ultimately it's just postpone the inevitable. But here's what happens in 1929 and beyond. Global trade absolutely collapses. This is what we call a Kindleberger spiral. It is best with great sound effects, but I will spare them for you. But this is what happened to trade in 3 to 4 years. 1929 onwards to 1933. 65% down. Global trade today is sort of stagnant. So if you think of the currency wars, that's at least different. But of course, it comes from a period where it was growing very, very rapidly. So being stagnant is quite disappointing. But this is why Britain let go of the gold standard. This was the background. 65% decline in global trade. And that explained why we had FX wars, and then you can see that I stuck with the theme of this month. So the lesson there is, if you borrow, like I already said, it delays the inevitable, but ultimately high debt will cause a problem. You can go off gold to win if you are on the gold standard like people were in the 30s. All right, that's as far as the history lessons go. What are the parallels with the modern day? And I think one of the parallels that have been used a lot is unemployment. But arguably, unemployment, Harjan just mentioned it, 5% this morning. The participation rate is a little bit up. We're near full employment as far as the Fed's concerned. Sketch there though. First of all, the world's bigger than just the US. And if you look at a place like Europe, youth unemployment runs at around 50%. And it isn't just in Greece that that's the case. Youth unemployment in a country like France is 25%. So there's a real issue there still. And even in the US, if you start correcting for part-time workers, for people who are doing jobs that are not matching their skill set, you probably have an unemployment rate that more realistically sits at 10%. In any case, no one seems to be very happy, and wages haven't been moving everywhere. So there are some parallels here. It might not be as dramatic as the 1930s, but there are some parallels here at the moment. There's also something really different, though. There is no gold standard today. We have a system of fiat money. Money can be created without limits, and central banks can cut rates to zero. And they have been doing that. Rates are at their lowest level in 300 years. And if anything, they're finding out, as the ECB did recently, that they can probably cut rates just a little further. That zero bound seems to be quite a soft one. But they're also finding out something else. In a world that's very indebted, when there's a lot of debt, cutting rates to near zero has limited effect. Cutting rates even below zero has limited effect because it doesn't induce consumers and businesses, you yourself, to borrow more. If you think of it, even though we have a system of fiat money, we seem to be back on some sort of standard again. And we've been arguing that quantitative easing, all these extraordinary monetary policy measures, are the modern day equivalent of going off gold. It's central bankers running into the wall and trying to circumvent it. That's a very complex way of saying that they've run out of the conventional tools, and now all they have to create inflation and exports is to weaken the currency. And that's what they've been trying to do. But of course, if you do that as one of the first movers, it's great. But if everyone starts to do it, currency war, it becomes a lot more difficult to actually have an effect. And you need to do ever bigger things for ever smaller gains on that front. But it's difficult not to play, because if you don't play, it's like a prisoner's dilemma. If you're familiar with that from game theory, if you don't play, you definitely will lose. Like France found out in the 1930s. Right. I promised you I was done with the lessons, didn't I? One last thing there then. Quantitative easing is the easy way out when debt is too high. I sense a bit of skepticism. If you've been here a few years, you know that I'm usually less than gracious for the central banks and central bankers. But I think it is fair to say that there's a lot of smart people working for central banks, and maybe it is all a little bit too quick to say that all they're doing is just manipulating the currency. Maybe they do have a lot of other interests in mind, and it is all a coincidence, right? So to try and test that, I've brought a couple of charts with me, in which I'll show you the currency, and I superimpose on that monetary policy. And you have to forgive me, it used to be just interest rate differentials, but since we're done with interest rates, it will be just a time period of quantitative easing in various countries. And I started with the two early offenders. Because we may have already forgotten, but the US actually did play a role in this currency war. They fired some of the first shots together with the Japanese. Quantitative easing number 1, 2, and 3, and I've made this argument before, if quantitative easing doesn't work, they always do more of it. So we had 3 installments of it. Pushed dollar-yen steadily down, meaning the dollar got weaker and the yen got stronger. Now on these charts it's always deceptive, because you might think, oh, that's not that big an impact. More than 20%. So for the Japanese this was real. And the Japanese start to react, it's the blue blocks you're seeing there. And they push back and they start throwing the kitchen sink at it. They do their own version of quantitative easing. America decides, okay, well, this has been good. We'll taper, we'll start having a long drawn out discussion about the first rate hike, and it all reverses and dollar yen goes up. So it's exhibit A, that these central banks are watching the currency quite closely and their policies are very directly influencing it. Exhibit B is even more convincing, it's euro-dollar. And you can very clearly see that every time we had an installment of quantitative easing from the US, euro-dollar peaks. In other words, the euro is strong and the dollar is weak. 1, 2, 3. It is only when you get tapering that it stalls, and it is only when the ECB starts talking about its own version of quantitative easing and ultimately delivers some of that, that euro-dollar starts to tank and moves 30-40% down. Some big moves. So when central bankers say we don't watch that and there is no currency war, rank me among the skeptics. There's a new kid on the block as well when it comes to currency wars, and that's China. I'll share a few words with you on that because I'm aware that in many of your businesses, China has been wreaking havoc with things. China has a big issue, a number of them. I speak to quite a few of our corporate clients across the globe, and I tend to get a lot of pushback. And the story goes a little bit like this. People say, yeah, the Chinese, they've been doing this for decades. They don't have a pesky democracy. So when they have a plan, they execute it, they get it done. And we've talked to them, they have a plan, 5-year plans, they know what needs doing, they will execute it, they'll get it done. You're way too pessimistic when you're saying the growth in China will fall to 4.5% to 5%. Okay, right. Here's my version. In China, all of the easy things have been done. All the low-hanging fruit has been plucked. Right. They've done that, and wisely they've done it. That was a smart strategy. But now they find themselves in a situation where I think most developed economies are finding themselves. Their policymakers are smart. They know exactly what needs doing. But so do all the policymakers in the US and Eurozone. But it just never seems to be the right moment to take the short-term pain for the long-term gain. And that's what the Chinese are now running into as well. Meanwhile, domestically, expectations are massively on the rise from Chinese citizens about what they expect from their government. Does this sound familiar? Situation we also have in the US and the Eurozone. And compared to the US and the Eurozone, Chinese policymakers are even less equipped in terms of financial system, etc., to actually deliver all that. So that is the big problem here. Meanwhile, they're trying to transform their economy, and they know what needs doing. They need a more consumer-driven economy, but that's easier said than done. Their big problem is, if you want consumption, you need to reduce savings. How do you reduce savings? Well, the Chinese are genetically disposed to save more than the rest of the world. Nonsense. The Chinese save more because they have, unlike us here, different incentives. They live in a different world. Financial markets are in their infancy. There are precious little financial products to support them in their consumption drive. They have very little tools to lay off risks. If they want to buy a house, they need to do it in cash. If a family member falls ill, you need to have cash to go to the hospital. If you're one child, is talented, needs to go to university, you better have been saving up for it for 20 years. That's why they're saving. So you need to build a social security system, you need to build financial markets, and the kind of products to reduce these savings and build a true consumer-driven society. That's hard work, that's very difficult, so the Chinese have taken a few shortcuts. The first shortcut, I've forgiven them. It's the housing market. They had a housing market bubble. We all had those. So, okay. We'll notch it down to you also were in the housing market bubble. This one, this is mismanagement of the first order. This should also make you wary of blindly thinking that Chinese policymakers know what they're doing. This, and the chart, think of it, this is January 2014. In 2007, 2008, the Chinese have a massive equity bubble, and it ends with a 70% correction. This is not 50 years ago, this is 7 years ago. And yet they do it all again in the scope of 1.5 years. This is a bubble. It went bust, and unwisely, policymakers started intervening. Unwisely because it has damaged institutional investors' trust in these policymakers quite substantially. We've labeled this, and you will be familiar with the mark-to-market paradigm, we've labeled it Mark-to-Marxist. And if you ask me, is there further downside? Well, I'm no equity analyst, but to be fair, very simple. It was a 70% correction in 2007. The bubble is every much as big this time around, and we've only seen a 42% correction at the low. So there could be further downside there, if you may. Not the message you want to hear, but this was the other way they tried to do a shortcut. They tried to get a housing bubble and an equity bubble because that brings money into the wallets of the consumers. They got the retail investors involved in this. But you can guess what that correction did to them. So these shortcuts don't work. I'm not talking about an implosion of China, but they have some real challenges, and it's not as easy going as it was the previous decades. Throughout all this, the Chinese have to figure out ways to deal with all this. And a lot of the reforms are difficult. You have to take from Peter to give to Paul. So you're looking for quick wins, things that are easier. So how insane is it that the renminbi is at exactly the same rate now, roughly, as it was 1 year ago? That makes absolutely no sense because the economy is in a much weaker state. But I'll give the Chinese credit for this. In 1998, they didn't move the currency, Asian financial crisis. 2008, they didn't move the currency. So they have a pretty dogmatic view on this. They believe that currency stability is a good thing in this case. But it's different this time around, because in 1998 and 2008, they were not the problem. Now, arguably, they're one of the key problems in the global economy. It sounds overly dramatic, but it means that they need to do more, and they've done all the easy work, so they need to really think about the currency as well. They've kept it stable in part because they want to be a reserve currency. If they're truly a reserve currency, you don't need FX reserves anymore. It's the situation the US is in. So they've been recently admitted to the special drawing rights of the IMF, and that admission may mean that they now have a little bit more leeway to let the currency go. One argument I want to make, though, is that if you're in the special drawing rights, like these other currencies are, ranging from euro, yen, sterling, you certainly don't have to be stable. These have been very unstable currencies, actually. There's no problem at all. Nothing that says you need to be stable to be in there. Secondly, China is certainly not going to be a reserve currency anywhere soon, because being in special drawing rights may help a little, but the main problem China has ranges from no convertibility of the capital account. You know that list. I won't bore you with it. The key problem, though, is very intuitive. If I gave you a couple of billion of renminbi, what would you do with it? It's not that easy. If you need to invest it, there are no quality financial assets in China. You can't even invest it in government bonds. Local government bonds, perhaps, but I wouldn't touch them. And in the equity market, well, you saw the hiccups in that. That might not be so stable a place either. What makes economies like the US great is that you have deep, liquid financial markets in which people have trust and in which you can park your assets. That is the key reason why the dollar is the world's reserve currency. And that is also a reason why a currency like the euro or the sterling is also among the reserve currencies. That's the challenge China needs to overcome. We argue that despite China having massive FX reserves, they're also a very big economy, so they need very big FX reserves. IMF has a formula for that. I have that in the blue line here. And the orange line is their actual FX reserves. They do a lot through the forward market. I won't bore you with the technicals, but it means that essentially their FX reserves are under a lot more pressure than you've seen in recent months. Right? And you never want to wait until the market forces the issue. So there's pressure on them to really move this. We have an out-of-consensus view that we think within a year's time, they will let the yuan depreciate 20%. That sounds like a lot. Think back of the 1930s. And think back of the challenges that China has. Once they let it go, they'll move it a lot. I know that, of course, we had high visitors from China recently in the US, and they said we won't do anything. But that's always what officials say before they move. Right? This is the way it works. And some of the patterns we're seeing are very reminiscent of what Thailand did just ahead of 1998 when the Thai baht went completely. Now, China is not Thailand, I do get that, but like meddling in the forward market to cover things up, well there in that space. So China has issues, and the currency is part of that solution. And amongst all those unpalatable solutions, we believe that the currency definitely has to be part of that. Right, enough talk about far, far away. Let's talk about the Fed. Before I go there, though, I want to serve the wisdom of the crowd and ask you this question. If the Fed indeed raises the benchmark rate, the Fed funds rate, later this month, are they making the right decision? Number A, no, they're anyway too late already. B, no, they're actually too early. C, yes, but they should remain very cautious. This is the prudent approach. Or D, yes, but it's time for a forceful follow-through. In other words, this should be a series of hikes hitting us next year to finally normalize rates. 10 seconds. Let's look at the results. It's the cautious approach, isn't it? That's also our forecast. We're looking for a hike this month. We've been looking for that for 1.5 years. In varying episodes, we were either seen as totally out of our mind or now correct, hopefully. We're looking, more importantly, next year for only 50 basis points of hike, and the year after that only 100. So it's a very, very slow pace. Let's take this forward to show you what the Fed's motivations there are. The problem for the Fed really is going to be that once they start normalizing rates, the dollar index may become a lot stronger. And again, if you're on the wrong end of that currency war, everyone else is easing policy, your economy may start to get hurt. They're looking, of course, at unemployment, which is 5%, looking at wage growth, which is not really there, and looking at inflation, which core inflation is there, headline inflation is not there. They can twist this. The key element to remember, though, for the Fed is they feel the recovery is long in the tooth. They fear that there will be a new recession before they have the fresh ammunition. So a lot of people talk about the Great Recession, but I would like to focus you on the long recovery. Because it's been going on now for 75 months. The average recovery lasts about 58 months in the post-World War II era. This is not a hard and fast rule. There are no good academic theories for this. But you can see where a recession may be coming again, and then you want some ammunition, and that's where the Fed is mostly concerned. So they'll twist and turn until they can actually bring some of those rate hikes. This is the argument here of that recession being overdue again. Main cause of recession, if you wonder, I've listed them here. I would say monetary policy shocks and especially financial bubbles due to all these low rates are definitely key risks out there. And then the ECB. Yesterday, the ECB announced 5 new measures easing policy. They're going to buy more paper, state-owned enterprises. They've moved up the end date of their purchase program. They've cut their deposit rate, finding out that in Switzerland it worked, so why wouldn't it work for the ECB? And yet, euro-dollar went up a couple of big figures. That may have surprised you. The reason is that Mr. Draghi promised a whole lot more, it seemed. And he got a reputation for exceeding expectations. It's a dangerous reputation to have because one day it's mark to market. And that happened yesterday. Mr. Draghi also has a bit of an unpleasant way of working. And I think that's also what we've now seen. He tends to go and give press conferences about what the ECB is going to do without actually talking to the governing council first. And then he sits down with the governing council and he says, market expectations have already priced this in, so we better deliver. So I suspect that amongst the core countries, some of the policymakers have actually come back and said, no way, not this much. And now we have the worst of both worlds. You're playing the currency wars, but you're playing them half-heartedly, so you're losing them, and you're still easing policy, so you're still giving away the few instruments you have. Not really well played, if you may. And of course, because more countries are playing, it's becoming harder and harder for the ECB to have a real impact there. That brings us, perhaps a side note, if you thought like, oh, but the ECB can just rely on the Fed, Jan. If the Fed does the hiking, then euro-dollar will go down. The ECB doesn't have to do anything. But the problem for the ECB is, it isn't just about euro-dollar. It's about the trade-weighted euro against all the currencies. And if the Fed hikes, emerging market currencies are probably going to be under pressure. Commodity currencies are probably going to be under pressure. So the trade-weighted euro may actually go the other way around. So the ECB cannot rely on the Fed just there. The ECB, by the way, believes that what we've seen in terms of disinflation and lower commodity prices is actually a positive thing. In their heart of hearts, they believe that this will be good for consumers and businesses. But it takes 12 months to see that. They can't trust on that. They are afraid that maybe instead of it being supply-driven, it might be the global economy tanking, and therefore they have to take out an insurance policy. What does that mean for euro-dollar? Well, I think in the upcoming years, we are going to test and go through parity. It is hard to see how we can avoid that. The US economy is in better shape than the Eurozone. That ultimately weighs here, and the Fed is simply tightening where the ECB is easing. Sometimes the job isn't all that hard. But it is also not a straight line, and it's not that simple. We have had a big move in euro-dollar in recent years, and some of that is being consolidated. And you can see that now when we're trading at 108, 109, rather than already towards parity. So we have on a 12-month horizon 104 for euro-dollar. The risks there are firmly on the downside, I think. But broadly speaking, the trend where the dollar is gaining just about against every other currency will continue next year. The gains will be more moderate. A lot has been priced in. But it is something that, again, a message you probably don't want to hear so much. To sum it up, in a world with weak global demand and very high debt, quantitative easing is the only tool sort of left for these policymakers. That suggests currency wars are inevitable. Now, is there an alternative to all this? Well, sure, you could get your textbooks out, do all the structural reforms, the debt defaults, address income inequality, which I spoke about last year, if you remember that. Get surplus countries to increase spending, like Germany. And when you do all that, re-regulate markets, figure it all out, because else those who do the good work will not reap the benefits. But if you're skeptical reading that list out there, then you're not alone. I'm skeptical. And that's why I believe that currency wars are far more likely, even though everyone knows that by itself it's not the best option. You also know if you don't play, you end up being France in the 1930s. Instructive here to end also with sort of the cycles we've seen in history. We have seen three periods. We've seen wars, we've seen FX stability and FX instability. We hopefully have done away with the wars part, but we still see periods of stability and instability alternate. I've listed them here all the way from 3000 before Christ. I won't completely run through it, but you can see that at the last bit, that we went from a situation of the Asian financial crisis, 1997, 1998, to a stable period, then a 2008 Great Recession, and now we're in currency wars. We're overdue a green period, but I don't see it in the upcoming years. I think the currency wars are going to continue, and that means big movements, big winners and losers if you're not playing, and those who don't want to play like China will probably be drawn in, and there's a risk the US gets drawn in again as well. No matter what, I'll leave you with a note of advice then, again, in spirit of the movie coming out this month. Keep calm and may the force be with you. Thank you very much.
Question on South America. What do you see happening down there? Argentina, new elections. What does it do to the currency? Brazil, what does it do? I think for the commodity markets, very important.
Yeah, I was afraid you were going to ask, because I know there's a lot of Mexican clients, we have Canadian clients, we have some Brazilian clients, so I was afraid you were going to ask, like, which of the three will do worse in terms of the currencies there. On the Canadian dollar, we expect them to do sort of keep range bound in the trade. Peso can do reasonably well. It's always a difficult one because they use it as a proxy trade, right? If you want to short Brazil but you can't, you short the peso instead. It's a bit of a sad story because Mexico has done some good reforms. You were asking though about Brazil and Argentina. Now on Argentina, I can give you a forecast, but it would be a range. And when economists and strategists give you ranges, they have no clue. The problem is, with new government entering town, they're making all the right noises in terms of saying, okay, we're going to deal with the Kirchner era. We're going to actually revamp the statistics office so we get reliable data from that again. And we're going to let the currency trade freely. But they're already backtracking on that latter part because they're afraid that on day one the currency goes 50%. And that's why it's so hard now. I think literally the range of forecasts when I discussed it with Christian Lawrence, who covers this for us in detail, was 10 to 18 for Argentina there. So that's really massive range. Really have to watch that very closely. On the Brazilian real, I can be a lot more detailed. Brazil is in a whole lot of trouble. Its economy is set to shrink 3.5% this year, 2.5% next year. It's a moving target in the wrong direction. It has an inflation problem, and it has a problem where increasingly the central bank can't do much about that. Economists call this beautifully fiscal dominance. It means that the fiscal situation is so bad, and the way you fund it in the Selic rate, the short-term interest rate, is such that as a central bank you can't raise rates because it will hurt your government to such extent. Brazil has long-term problems, but it has, of course, short-term, a commodity boom going bust, and political issues to deal with. It's a lot. It's a lot. And the sad thing is going to be, a lot of people were lifted out of poverty in Brazil over the previous years. You can have a view on whether those were wise policies or not. Some of it was income redistribution, but I think some of that will have to be reversed to keep things sustainable. So it's a tragedy there at multiple levels. In terms of the real, it has no business being south of 4. We think it will trade around 4.4 end of next year. Thank you for that. Any other questions?
Yes, sir, Jan. Yesterday in the resource management breakout session, we got a fairly unfriendly view of oil prices from Leo McGarry at the Kennedy School. So I'm curious about the overlay of how that, let's say that actually happens and we do go into mid-20s on oil prices around the world. How does that play in all this scheme about currencies and about geopolitical impact of that? That's a little bit off the topic, but...
Two parts. First off, we don't think it will go to 20. So in terms of our base scenario is that it will be a range of 40 to 60, and we're a little bit on the higher end of that range. There's a supply and demand story here playing out, of course. Supply remains high in these markets. The argument was yesterday already made about the rig count, that yes, rig count in the US is down, but quality bias is at play here, and the actual production has only fallen a little bit. Demand is reasonably good. Someone asked me a very good question recently. They said, well, how can it be that even China growing 5%, that's more than 10% 10 years ago, how can it be that there's not, why are people talking about no demand? But it's of course also because these economies are becoming more energy efficient. Specifically on your question, how does this play out? It will intensify currency wars, is my opinion. Because what central bankers are going to face is more disinflation from this. They will think it's supply driven, but they cannot be sure. And because they cannot be sure, they will take out insurance. They will be worried that it's a global meltdown in terms of demand, and they will start doing ever more extraordinary monetary policy measures. That's what the ECB is doing. They're doing it hesitantly this week, but ultimately the direction of travel is quite clear. So I fear that if that scenario were to come through, it will intensify these currency wars.
Sorry, Jan, quick question of the imminent interest rate rise. What would you say is obviously advised to corporates to lock in the rates now for longer term? Have you any views on that, or is that?
Oh, we definitely have views on that. To be fair though, they've been consistently wrong for a few years. We've been forecasting just about every year that interest rates would go up, long-term interest rates would go up 100 basis points. That's not been happening. I'm saying this because you must be well aware of that. I'm very aware, I'm trying to make this argument because you will be like, oh, here he goes again. He's telling us to lock in long-term rates. you may still be quite safe being on flexible rates. And the reason is that unless US wages are going to really kick off, US wage growth is going to kick off, long-term rates are not moving up. So the Fed's hiking is flattening the curve rather than steepening it at the moment. Because people are not believing that this will lead to wage increases and inflation expectations on the rise. That's the key variable to watch. If US wages are going to kick off, then not just for the US, but globally, that will really start pushing these long-term rates up. Because that's when the scramble for the exit is going to come. Because then a lot of people are going to be, okay, wait, we misread this situation. This isn't Japan for the next 2 decades. This is actually looking more like a classic situation, and now I want to lock in that low rate. Of course, then you may be a little bit too late, but for the time being, our base scenario is that US wages are not moving up dramatically. The Fed's pushing on a bit on that string, curve flattens rather than that it massively steepens. So you still have some room there, it looks like, mindful of the fact that we've all become a little bit more humble in terms of forecasting these long-term rates. Thank you very much.